You are listening to The Intellectual Investor, episode number 240, The Impact of Higher Interest Rates on the Economy, AI Edition. Welcome to part 2 of my AI experiment. Over the next few weeks, I am letting AI take over to inform, educate, and maybe even entertain you. I handed a few of my essays to Notebook LM, Google's AI tool, and asked it to turn them into a radio show-style dialogue between two hosts. My instructions were simple. Here is my essay. I'm taking a break. Educate and entertain my readers. You can read the original essay at a link in the show notes. Share your thoughts and pass it along to friends, enemies, or random strangers. In this conversation, our AI friends will explore how rising interest rates are reshaping our economy after years of near-zero rates. Using the analogy of gravity, we'll examine how this shift affects everything from housing to government debt and what it means for investors. The impacts are still unfolding, making this discussion as relevant today as when I wrote it last summer.
Hey everyone, welcome back. Today we're switching things up a bit. We're diving deep into a letter from investor Vitaliy Katsenelson. He's actually taking a break from writing and asked us to kind of unpack his thoughts for you all while he's away.
Yeah, and it's pretty perfect timing, actually.
You're right.
Because even though this letter is from the summer, his insights on rising interest rates are even more on point now than they were then.
Totally. And you know what really grabbed me?
What's that?
That analogy he uses comparing rising interest rates to gravity, like suddenly snapping back to normal after being super low for ages.
Oh, yeah. That's a good one. It really makes you think.
Doesn't it? It's like we've all gotten so used to these crazy low interest rates for 2 decades now?
At least.
That it's like baked into our brains how we make money choices. Like we've forgotten what normal even feels like.
It's true. And that's kind of where the risk comes in. Everyone's been making decisions, businesses, consumers, even the government.
Oh, yeah, the government for sure.
Yeah, they've all been acting in this low gravity world, taking on more risk than they might have if rates were higher.
And Katsenelson, he lays out some really good examples.
He does.
Like for all regular folks think about buying a house or a car or even doing a big renovation.
Mm-hmm.
With those low rates, people were all about the monthly payment, making sure it fit the budget, but not really thinking about what it means down the line.
Exactly. And then you've got businesses who see those cheap loans and go all in on expansion, new headquarters, factories, new markets.
That's like a feeding frenzy.
Totally. And then there's the government piling on debt with ideas like modern monetary theory saying it's no big deal when rates are basically zero.
Okay, hold up for a sec. For those of us who aren't econ experts,
Sure.
Can we break down this modern monetary theory thing?
Oh, yeah, absolutely. So basically, it suggests that if a government controls its own currency, it can just print money to pay for stuff without freaking out about inflation as long as interest rates stay low.
So it's like a magic money tree.
Well, not quite.
Oh.
But you can see how that kind of thinking gets distorted when you've got these super low interest rates hanging around for so long.
For sure. So how does this all connect back to the gravity thing?
All right, so picture this. You're an astronaut bouncing around on the moon.
Okay, I like where this is going.
You can jump over rocks like it's nothing because the gravity is so weak.
Right.
But then you come back to Earth and try that same jump.
Oof. Yeah, that's going to hurt.
Exactly. You go splat, and that's kind of what Katsenelson is saying about these rising interest rates. It's like that sudden return to Earth's gravity.
So all those choices we made when things felt light and easy, they suddenly look a lot riskier.
Exactly.
And then there's the delayed impact of all this, which Katsenelson explains really well with the example of those 30-year mortgages.
Right.
A lot of homeowners locked in those super low rates feeling like they scored big time. But
there's a catch.
Always a catch, right?
If they need to sell and buy a new place, they're gonna get hit with those much higher rates, meaning way bigger monthly payments.
Right.
Yeah, and that's a big reason we're seeing fewer houses being bought and sold. People are basically stuck even if they'd like to move.
It's like being trapped in some financial time warp.
Kinda. Yeah.
And the government, they're not exactly immune to this either, are they?
Not at all. The average maturity of government debt is about 6 years, which means refinancing at these higher rates, it's a problem. And that leads us to another big point Katsenelson brings up, the impact on corporations.
Oh, yeah, they're definitely feeling it. Some companies played it smart and locked in those low rates for the long haul.
Ah, the lucky ones.
Yeah, but plenty of others are facing these refinancing challenges, and that's when things get kind of scary, especially for companies with lower credit ratings.
I see.
They become much more likely to default as the economy weakens.
Yikes. So Katsenelson is painting a pretty serious picture here. What does he say investors should be doing in this kind of situation?
He's all about focusing on companies with what he calls staying power.
Okay, what's that mean? Think solid balance sheets, steady cash flow manageable debt. Basically, companies that can handle a rough patch without needing those low interest rates to prop them up.
So ditch the get-rich-quick schemes and go back to basics.
Pretty much, it's all about quality over quantity. And remember, this isn't just about picking stocks. It's about applying that same logic to your own finances.
Right, so how does this whole return to normal gravity thing actually affect us regular folks, the ones who aren't exactly poring over balance sheets every day?
Well, think about it this way. If you've been used to cheap, easy credit for years, it's easy to overspend or take on more risk than you normally would. Maybe you bought a bigger house than you needed because the monthly payment seemed okay with those super low rates.
Or splurged on a fancy car or a dream vacation because, hey, why not? Rates are low.
Exactly. But now as those rates climb, that debt gets heavier. And if you burned through your savings during the pandemic or your income takes a hit, you're suddenly in a much tougher spot.
It's like a double whammy. So what's the solution to this low gravity mindset? How can we gravity proof our finances, so to speak?
First things first, take a good hard look at your finances. Where's your money going? What are your debts? Do you have an emergency fund? This is the time to get real with yourself about your financial health.
It's like taking stock of your financial toolkit.
Precisely. Once you have that clear picture, you can start making adjustments. Maybe that means cutting back on some unnecessary spending or finding ways to pay down that high interest debt faster.
Makes sense. What about investing? Should we be changing our strategies given this new reality?
It's definitely something to think about. Historically, value stocks, those are companies that the market thinks are undervalued.
Okay.
They've done better than growth stocks when interest rates are rising.
Interesting. So maybe a more conservative approach is the way to go.
Could be. Remember, this isn't about perfectly timing the market. It's about making sure your investments align with your long-term goals and how much risk you're comfortable with, especially as the economic landscape is shifting.
And I know a lot of folks are wondering about real estate. We've talked about how these rising rates are shaking things up on the housing market. But are there any opportunities there for smart investors?
Oh, for sure. The real estate market is definitely more complicated now, but there could be some good opportunities, especially in the rental market.
Oh, really?
Yeah, as mortgages get pricier, renting might become more attractive for some people, which could push up demand for rental properties.
So maybe it's time to think about becoming a landlord instead of focusing on owning a home.
It's definitely an option worth looking into, but do your homework understand the local market before you jump in?
Right. Real estate is always so specific to the area. What other advice would you give to people trying to navigate this return to normal gravity?
Stay informed. Keep an eye on those economic indicators like inflation and interest rates. Understand what's driving the economy so you can adjust your financial strategies as needed.
So don't just bury your head in the sand and hope for the best.
Exactly. Knowledge is power, especially when it comes to managing your money in a bumpy economy. And remember, this is a journey, not a quick fix. Small, consistent changes over time can make a big difference in building that financial resilience.
It's like we need to retrain our financial muscles to operate in this higher gravity world. We've gotten so used to that moon-like weightlessness that we get adjust to being back on Earth.
That's a great way to put it. We need to develop that financial discipline and resilience so we can handle whatever economic storms come our way.
And Katsenelson himself, he's embracing change. By taking this break from writing, he's kind of passing the torch to us to unpack his ideas and keep this conversation going.
Yeah, it's an honor to be able to do that and hopefully get our listeners thinking about all of this.
Absolutely. And for those who want to dive deeper into Katsenelson's work, those insightful essays and podcasts, be sure to visit investor.fm.
It's a goldmine of financial wisdom, especially for anyone trying to understand these crazy times we're living in.
Well, we've covered a ton today, but there's still more to discuss. Stay tuned for part 3, where we'll explore some more insights from Katsenelson's letter and talk about what the future might hold. So, as we wrap up this deep dive into Vitaliy's letter, I keep thinking about how much he packs in there. We talked about consumers, businesses, even touched on the government, but
Yeah.
I think it's worth circling back to that last one, the government, because his points on government debt are kind of unsettling.
Oh, absolutely. It's something people don't always talk about. But Katsenelson, he makes a really strong argument that it's a huge risk, especially now with interest rates going up.
Yeah, and how does he connect that to rising interest rates?
Okay, so think of it like this. When rates are low, the government can borrow a ton of money without it costing too much.
Right, makes sense.
But then those rates go up, and suddenly all that debt, it's way more expensive to deal with. Like, imagine you get this massive mortgage when interest rates are super low, and then boom, they double or triple a few years later. Those monthly payments are going to hurt.
Ouch. And in this case, those payments are coming from us taxpayers, right?
Exactly. You and me footing the bill. And that's why Katsenelson says it's so important for us regular folks to understand this whole government debt thing.
Right.
And to hold our elected officials accountable, make sure they're being responsible with our money.
So it's about more than just voting. It's about making sure they have a plan for the future, not just making promises they can't keep.
Exactly. We need real solutions, not just empty words. And Katsenelson, he doesn't stop at government debt. He's also worried about corporate debt, especially for those companies with not so great credit ratings.
Right, he talked about that, yeah. What was his take on that again?
Well, he says those companies are really vulnerable when the economy gets shaky and rates go up. They have trouble making their debt payments, and that can set off a whole chain of defaults, you know, like dominoes.
Yeah, that's scary. So it's not just about picking the right stocks. It's about understanding the whole economic picture and how everything's connected.
Exactly. It's a big, complex system, and that's why Katsenelson's advice for investors, it makes sense, even if you're not a Wall Street guru. He says, focus on those companies with strong balance sheets, steady cash flow manageable debt.
The steady eddies.
Yeah, exactly. He calls them companies with staying power, and he's all about quality over quantity.
Makes sense. So basically stick with the tried and true companies, the ones with a good track record, the ones that can weather the storm.
Exactly. They might not be the flashiest or the fastest growing, but they're stable and resilient, and that's super valuable when things are uncertain.
Say, we need to find those companies that are heavy enough to stay grounded, even when the economy gets crazy. Like those big oak trees that can handle the strongest winds.
That's a great analogy. It's about looking for companies that are built to last, not the ones riding on cheap credit or hype.
And that brings us back to Katsenelson's whole gravity analogy. We need companies with enough financial weight to handle this return to normal gravity.
Absolutely. And it reminds us that being able to adapt and being resilient are so important in the financial world. We can't control everything that happens, but we can control how we prepare and how we react.
So true. And Vitaliy, he's modeling that adaptability himself by taking a break from writing. He's trusting us to keep the conversation going and share his ideas with you all. And he also wanted to remind everyone that this letter, even though it's from this past summer, it's more relevant now than ever.
Absolutely. And if you want to hear more from Vitaliy himself, check out his website, investor.fm. He's got tons of great stuff on there. Essays, podcasts, all sorts of insights to help you navigate these crazy times.
So much good stuff to explore. Well, this has been a fascinating deep dive, but we've only really scratched the surface. The economy is always changing, and it's up to each of us to stay informed, make good decisions, and adapt to whatever comes next.
Exactly. Stay curious, stay engaged, and keep learning. That's the best way to thrive in a world where the rules are always changing.
Great advice. Thanks for joining us on this deep dive. We'll be back soon with another insightful exploration of the financial world. Until then, stay curious, everyone.
Thank you for listening. If you know someone who'd enjoy this episode, share it with them. To listen to more episodes, visit investor.fm. Enjoy life and prosper.